Hello and welcome to today's Trade Tracker. Today is Tuesday. It is December 30th, 8:27 p.m. Central Standard Time. And I'm really excited about what I have to share with you today. It's exciting. We have the end of the year coming up. Tomorrow is December 31st, end of 2025. So it's been a very exciting year. And I want to thank you for tuning in and watching. For those of you that are interested in learning more about trading, let me explain to you big picture what this is all about. I don't ever try to predict the market or anticipate what's going to happen. The way I trade, I've been doing this for almost 22 years now. What I found that works, and I've tried pretty much everything, believe me, what works the best is put yourself in the most highest probability position you possibly can. High probability trading, okay? It's like a casino. I'm sure a lot of you have been to Vegas or been in a casino. So why does it the house always win, right? I mean, they don't win every bet, but the house always wins over time. Why is that? When the guest comes in, they typically lose, and the house typically wins. That's because, quite simply, the casino follows structure. They have rules, they have minimum bets, maximum bets. When's the last time you saw one of those blackjack dealers or a craps dealer really get excited and jump up and down about anything? They don't. They keep their emotions intact, and it's very businesslike. And then on the other side of the table, it's the exact opposite. The gambler comes in, they don't have any structure, they don't have any rules. Their emotions are all over the place. That's why in Vegas, they give you free drinks a lot of times when you gamble. They want your emotions to play into it because that's when people typically make the wrong decision. So I'm trying to help people when it comes to trading operate like the casino. Both sides are gambling, right? The casino's gambling, the patron's gambling. But one side typically wins a lot more than the other. I like to structure my trading that way. It's very important to manage your risk. Operating within a structure, I'm going to talk about that. I have a slide I'm going to talk about, which is a very good slide about operating within structure. Structure doesn't limit you. Structure provides you the opportunity to profit in a very consistent way. It's all about managing your risk and putting the probabilities on your side. If you simply do those two things consistently and try and keep your emotions out of it the best you can, you're going to do way better than if you don't follow those two items. We'll dig into that more during this video. What I do is to start with the big picture, start with the NASDAQ, and then I go down to the smaller time frames. The reason I choose the NASDAQ is because you have a lot of volatility, and you have plenty of liquidity, plenty of movement. There's no problem getting in and getting out. What I show you, you can use with stocks, you can use with commodities, S&P, you can use on the Russell, anything else you want, any other futures contract, whatever you want, okay? It's all about price behavior and risk management. I just like using NASDAQ. I choose to focus on one market and just get to know it inside and out. It has a pattern to it, it has a rhythm to it. Whatever you want to trade, whether it be Bitcoin or stock or whatever it is, I suggest you initially start with one and just get to know how it trades. And you're going to do way better than trying to bounce around all over the place with different stocks and futures and whatever. So that's why I like to use the NASDAQ. I always start with the big picture NASDAQ. I always start with the larger time frame and then we move down to the smaller time frame. I'm going to get into the Apex multiple time frame trading strategy. That's something we can use on the much smaller time frames, as low as the 1 minute chart for some of you that like to use a small term. Next week, I'm going to show you probability bands. These are very powerful price levels. Price loves to gravitate towards probability bands. Probability bands are based on Fibonacci, the Fibonacci numbers, the whole Fibonacci concept. I suggest you Google that, read it, or read it on AI, whatever you want to do. We'll cover that in January when I get in some of these in-depth classes. It's a phenomenal way to put the probabilities, put the edge in your favor with the Fibonacci numbers. It's just amazing how price gravitates to those numbers when you manage risk and operate within a structure. It's amazing how well you can do with that. You only need to win about 60% of the time, as long as your risk to reward, meaning what you're risking, say, is $1, and your reward is $1.50. It's a ratio 1 to 1.5. If you simply just win 6 out of 10 of those with the risk ratio 1 to 1.5, you're going to do extremely well. Mathematically, it's a profitable equity curve. And that's all we're trying to do is use mathematics, some geometry, risk management. Trading is not nearly as hard as people make it out to be once you have structure in place and you reduce your emotions. So anyway, we're going to kick in here. We're going to get things started. Don't forget, if you like what I have here, don't forget to subscribe to my YouTube channel. There's a red little arrow. You can subscribe to that or click the subscribe button, whatever it is, you'll be notified. All right, let's dig right into this. This is the daily chart of the NASDAQ. What you see here is this is the all-time high. This was a couple months ago with the all-time high. As you can see, we have a pattern here where trend line's coming down, and we hit it up here right around first part of December, and now we're bouncing off it once again. For those of you that don't recognize what we're doing here, it's this chart over here. You remember this one where we have the different levels. The market started here back in 2019. I started tracking this as far as these different levels, these different channels. The market's been operating in these channels. Right now we're over here. What I'm showing you is just zoomed in view of that. Okay. So just kind of big picture. We don't trade off this. We just try to get an idea what the market's doing. We had a higher high, lower lows. Now we have a lower high. Here, once again, another lower high, and we have this trend line. So you can see the market, a lot of the big boys, the big girls out there, the algorithms. I'm just putting here visually what the algorithms out there and what they're watching. So this isn't magical. This is just self-fulfilling prophecy, what the banks, the hedge funds, money managers, what they're doing out there. They're very much aware of these. They don't draw it in like this. It's all mathematically with their algorithms, but they have it in there. Now we are here, we're bouncing off this trend line. Could this turn and go up? Of course it can. But all we're doing is trying to get an idea of what side of the market we should be on. Should we be going long or should we be going short? We can make money either way. What side we want to be on and position ourselves accordingly. So right now the market is losing momentum. We hit the all-time high over here, and it's been, for the last couple of months here, it's been drifting sideways, going down a little bit. So we are starting to see weakness here, and we'll see what happens moving forward. This is another chart here I like to look at. I like using momentum bars. This is the momentum bar 42. What this does takes time out of the equation. So the bars have nothing to do with time, because it really doesn't matter the length of time when it comes to figure out momentum. I like the 42 for a lot of my charting analysis. As you can see here, I showed this a bunch of times. I'm not going to spend a lot of time on it, but basically, for those of you that didn't see it, you can go back to watch the other couple sessions we have. Basically, what we have here is when price is 500 points above the 200-day moving average, it's like a rubber band. The market breathes in, it breathes out. Nothing goes up forever, nothing goes down forever. The market breathes in, breathes out. It's like a rubber band. When it stretches too far, typically it wants to come back like it did here. Once it gets up 200 points above the moving average, it wants to come back. Came back here a little bit, comes back here, right? And then we can start seeing the weakness. Right up here, we have got about halfway up this band here. Now it's down about the last quarter of the band. Then we see the weakness coming in. Once we see the moving averages cross, we know there's some more weakness. Now it goes the opposite way, right? Now look at it drops, right? Price gets near 500 points below the moving average, and it wants to pop up. It's that red line, the 200 period moving average. It's like a magnet. The market wants to get back to that 200. It's an average. And that's why the market wants to get back to there, because by definition, that's where it wants to go back to, is an average, right? It comes down here 500 points away from it, wants to come back to the average. You can see right here, the exact same thing. It went up, comes back down to the average. It's not going to hit it every time, but do see it get to that point. You want to go down to your smaller time frames, and then you want to start looking at entry points. We don't trade off this. We're not making buy and sell decisions off of this. We're trying to get an idea where the market is, right? If it's up here, way stressed at this peak like it was here, over here, all these different times it was stressed like that, we want to go down to our smaller time frames and start looking for short trade, getting in at an exact point, enter a risk management, put our profit targets in, and move accordingly. Okay, let's move on here. This chart here is familiar. A lot of you have seen this last couple of weeks. I'm just going to touch on this real quick and show you where we're at. This is showing the NASDAQ, and this is going back, I'll see July 31st. Here's the uptrend here. The bottom and the top of the trend line. October 29th, 2025, we hit the peak. And then we started seeing it come down. The bottom of the trend line, top of the trend line, bouncing in between. Now, what happened? We had some big news events here. It came out of the trend line. And what was very interesting was if you go back and watch the December 7th trade tracker video, we had a very in-depth discussion of why the probability was extremely high, why the market was to start dropping there. We didn't know how far it was going to go, but we did have a lot of reasons why it was going to turn and start dropping down. Then there it went. It dropped down considerably. What was most remarkable about this drop is once this happens, we get two key points. We have the low and the high, and all we do is do our Fibonacci measurements. And the Fibonacci, we have our ratios right here. The first ratio is the furthest one, is the 61.8, and the 50% ratio. And then you have your 38.2, and then you have your 23.6 retracement. What this are magnets where the market likes to go. When it got all the way down to the 61.8% ratio, that's called the golden ratio. Whenever the market retraced back 61.8% from the peak, it's an extremely high probability it's going to bounce and go the other way. So we were set up, this was a Wednesday here, 17th, so I wasn't able to do a video on that. But during that week, I had the setup here. I want to do live during the week when we start the Apex Trading Club in January. I'll be able to shoot videos out during the week and show you when this stuff is likely to happen. So anyway, here we bounced off the golden ratio. What do we do? Well, the first target is the 50% retracement target, that white line. It hit that. After it does that, the next move up we're looking for is the 38.2. We hit that. The next move up is the 23.6. We hit that. Then on 12/21, which is about a week and a half ago, we were talking about how we're into the profit zone. Here's the profit zone. That's between the retracement 23.6 ratio and the fib high. So this area right here is the profit zone. We're talking about how we're looking to be taking some profits and how the market is likely to turn here. If we're looking at probabilities, it's a very high probability. The market is not going to be able to hit this fib high. It's trying to. That's what it's trying to do right now based on the probabilities of these Fibonacci numbers. The higher probability is it's not going to hit that white dotted line. That's going to want to turn down and start falling back and retrace back down. That's the probability we're playing it right now. This has to do with creating a structure. And I'm not going to spend a lot of time on this, but when you're trading, you want to absolutely create a structure that you're trading within. And you want that structure to give you a trading edge. What I have here is an asymmetric geometric design. This is a very nice way to place yourself as a trader inside this type of geometry. What we're doing is when you enter a trade, that top line would be your entry point. And there's a lot of ways to enter into a market. It's remarkable to me how everybody thinks there's a magical entry. It's nothing to do with the entry. You can enter a lot of different places in the market. There's a lot of good entries, right? Some are better than others. But the way you're going to succeed trading is not necessarily finding the quote unquote ideal entry. You want a good entry, yes. You want an entry that's going to give you a higher probability, of course you do. But that's just the beginning. Once you have the entry, it's all about the structure around that entry. Where do you place your stops and how do you manage your trade? That is how you start developing the secret sauce within your own trading methodology. What I have here is a very simple diagram where you want to always have a fixed stop loss. I'll get into the Apex multiple time frame day trading strategy next and show you how we structure that. But it's quite simply this diagram. You want to have a fixed loss, so you know if you lose exactly what it is, and you want that not to be any big hit. You want that to be a small percentage of whatever you're trading. And then you want to set yourself up for unlimited profits. What does that mean? That means whatever you're buying, whether it be 4 shares of a stock or 400 shares of a stock or 4,000 shares, it doesn't matter the amount. Or if you're buying 4 contracts or 40 contracts, it has nothing to do with the amount. For example, let's use 4 contracts in the futures. So what you want to do is you want to take profits right away. So if the market starts going in your direction, you want to have some pretty quick areas where you're taking profit to pay yourself. And then you want to move your stop loss up to break even. When you do that, you're in a no-lose situation. Why? Because you paid yourself right away on those first couple of hits. And when the market moves up in your direction, You move up your stop loss to break even. Now those remaining two positions, you cannot lose. If the market comes back, you're going to break. If the market goes up, you get out of the profit. So you want to put yourself in that type of position as soon as you can. Once you do that, you're going to be amazed when the market starts moving in your favor. Sometimes it goes up significantly, right? But nobody knows how far it's going to go. We can all guess, have an idea or whatever, but it really, nobody knows. So all you can do is position yourself within your trade. So if and when it happens, you're in it for the entire ride. So let me show you what I mean by that. I'm not going to spend a lot of time on this. There's a lot of detail here, but given it's pretty much a holiday, tomorrow is January 31st, New Year's Eve. And a lot of people are off for a 3-4 day weekend. So maybe you have time to spend more time on these kind of videos. We'll get more into this when we open up the Apex Traders Club, how all this works. I'm not going to get into all the nuances of this, but quite simply, it's an automated system. You can see these arrows here. We had a short up here, but the point is, I'm starting my illustration from down here. We had a buy down here. What happens is we buy 4 contracts or 4 units or whatever it is you're going to buy. You can use this, like I said, in any instrument you want. I'm using the NASDAQ. We put a stop loss in right away. What I do is I put a 100-point stop loss in. So I know right away that if it goes against me, I'm out. There's my managed risk, okay? Now, if it goes up, I don't know if it's going to go up or not, and nobody knows. All we can do is have an entry here that we feel is going to have a high probability and then manage our trade accordingly. We have our automated entry. It's a very high probability entry, and then we manage it after that. So what we're doing as the market moves up in our favor, we have our targets, target 1, target 2. These are fixed targets that we put in. Once those get hit, you can see this red dotted line. We're moving up our stop loss. This is all automated, all programmed. So once we hit target 1, 2, and 3, as we hit those, we're moving up our stop loss. The fourth one is what we call the runner. We don't know if the market's going to continue to go up or if it's going to turn around and come back. All we can do is put ourselves in a position where if it goes up, we want to make money doing that. That's what happened here. These first 3 get hit, profit, profit, profit. Over here, you can see how much we made. We had the first target 120 points away, second one is 60, third one is 200. Each point, the micro NASDAQ is $2. So if it moves up to 120 points, 120 times 2 is 240 profit. So right there is a quick profit. This fifth one is going back about 10 days ago, around the 18th or so, when I started this on the last video. What we have here is we had a position here of over $1,000 that was open. None of this happened yet over here. We didn't know how high it was going to go. We didn't know if it was going to come back or go up or what. We just had ourselves positioned to go along. And we're here just letting it go up, right? That's all you can do. Just let it ride. So what we did, I'll show you what happened next. Market went up. When do we get out? We get out when we get a signal going the other way. So here we get an automated signal to go short. We exited there. We exited at 25,824. So that runner was nice, right? Because we got in. Where did we get in? That entry was at 25,000. We get out at 25,824. 824 points times 2. Right? 1647. That's just one contract, not to mention the other 3 hit early on. So that one there gave us the total profit. Normally, trades don't last this long, but it was a kind of a flat market the last 7 to 10 days. This one lasted very long, December 17th to December 29th. What we do is we're getting in and getting out because the market opens and closes, but we're long this whole time is the point. Over here, this is more realistic. They normally last 1 to 3 days. It's typically how they last. This is really unusual, but 1 to 3 days, this one here is more normal. So what happens here, we exit our run and we get out and we're done going long. Now what we do, which is really cool, is we just switch and go short. We do the exact same thing, but we flip it upside down. So now we close out everything going long. We got a short entry here. Our stop is 100 points above. We're trying to make money going down. And then as it goes down, you can see those green circles. Target 1 gets it. Target 2 gets it. Once profit is locked in on those 2 targets, now we have that asymmetric geographic analysis I showed you. Now we can do nothing but make money. We have target 1, target 2, and when it gets down here, move our stop to break even. So when all this is bouncing around here, either 2 things can happen. Either the market comes back and takes us out, the stop loss is at 0. So it's going to be a 0. So we have 2 winners. Worst case is we win. And now if the market drops down and goes down really far down here, we're still a winner because we still have these 2 winners. Now the last 2 are going to be winners. So the idea is to put yourself in that asymmetric position once you start your entry. That's how trading is done. When do we get out? As you can see right here, we got the signal to go the other way, to go long. So right here, you can see the target 1, target 2, and target 3 in the runner. Those 49.25 points basically 50 points times two is like $100. So we made almost $100 on those last two because we got out there, and that closes that. So now what we do is flip and go the other way, right? Now you can put your stop on the bottom, put your targets on the top, and go the other way. So I'm just trying to explain to you how this works. For the highest probability, I would not have taken this long trade here because we were talking about how everything's moving to the downside, right? Our larger time frame are sloping down. We have those lower lows and lower highs, and we're talking about how we're in the profit zone already on the larger time frame. So because of that, in order to put yourself in the most high probability position, at this point, we want to be flat or short, okay? This is different over here. This is back when we were in that run. I showed you when we bounced off the golden ratio and we were trying to hit these targets over here. Because we're trying to go up and hit those targets there, that's why we'd be taking a trade over here going long, then that's why we took those long trades there. As it turned, taking our profits, that's why we're going short here. So the point is, you want to align yourself with the larger time frame. If the larger time frame is going down, you want to take in short trades. If the larger time frame is going up, you want to take the long trades. That's how you put yourself in that most ideal situation to be most profitable. I just want to wrap up with the volatility index. This is really interesting. This is a chart that illustrates the volatility. I like using this because if I look at this chart, if I go back many years, these were the lows: 12.7, 14.1, 14.3. And what that means when it's low, that means the market is pretty boring. It's not doing much. It's just kind of slow trending up or slow trending down, or it's chopping. It's just not whipping around, okay? And that's what happens during these low points here with those white arrows, okay? This one is a zoomed in shot on the right of what's on the left. So I just want to focus on the left for now. As you can see, just a couple of days ago, we hit a low of 13.38. So we were right between 12.7 and 14.7. So we're right in the middle of the low of what we saw down here. This is telling me that the market right now is very relaxed. That means there's not a lot of excitement right now. But what happens if and when this line starts shooting up like it did over here or over here with these big spikes? When this shoots up, the market spikes down. So because we're way down here, I'm watching this to be very careful, because when this starts moving up, we're going to see the stock market dropping very fast. I'm not trying to time it, and I'm not saying it's going to happen tomorrow or next week or even next month. What I'm saying is I'm just aware of it, because it looks to me that the market is setting up over the next handful of months in the first quarter of 2026. It looks like, as of right now, the probability is it's going to start dropping. And if the market starts turning and we start hitting new highs, well, then, of course, we have to change our direction. It's kind of like when you're driving, let's say you're driving and you have your GPS on. You're just following it turn to turn left, whatever, go left, go right. And that's all we're doing here when we trade. We don't know if there's going to be a traffic jam 30 minutes down the road until we get there. Trading is the exact same way. We're not projecting what traffic's going to be like an hour or 2 hours down the road. We don't know until we get to that point what traffic's going to be like. Trading is the exact same way. This is like a GPS. We're looking at it right now, and what do we do tomorrow? That's it. And next week we do the same thing. What are we doing on that day for the next day? As market changes, we adjust. We don't try to guess where it's going to be next week or next year or next month or anything. All we can do is position ourselves today where it's likely to be, probability based, to place ourselves with the proper risk management and proper position sizing to place our trade accordingly. That's all we're trying to do. So I want to help you. If you're willing to follow along, feel free to join the Apex Traders Club. Like, open up mid-January. I'd love to have you be part of it. I'll be doing these every week. Don't forget to subscribe to the YouTube channel. I have some really good education on here on these weekly videos. I see a lot of people charging hundreds of dollars for what I'm going to be sharing for free on these weekly videos. Thanks for being part of this. Stay safe. And I wish you all the best for 2026, and I'll see you next weekend. Thanks again.